Good evening, everyone. Today we will be diving into mutual funds, and this is chapter 14. This is the team. We are Group L, and my name is Gabriella. So, the learning objectives for today are that we will weigh the advantages and disadvantages of investing in mutual funds, differentiate between types of mutual funds, ETFs, and investment trusts, calculate mutual fund returns, classify mutual funds according to their objectives, and finally, select a mutual fund that is right for you. Mutual funds are an easy way to diversify. We are going to understand what they are, learn how they work, and know how to pick them. Why we should invest in mutual funds are because it is a way of holding investments such as stocks and bonds. It raises money from many investors, pools it, and invests in a diversified portfolio of securities. Each investor will own their own shares proportional to their investment. And two of the most important things are that it provides diversification and professional management of assets. And it is also a great option for small investors seeking access to a broad range of investments. So, for example, if you only have $1,000, you should invest in a mutual fund as you will be able to diversify that small amount of money and also reduce your risk of loss. How a mutual fund works is that it clearly states its investment objectives. As investments grow, the net asset value or share price rises or falls within the market. Shareholders can receive one of three things, either dividends, interest, or capital gain distributions when the investment funds are sold for a profit. It is structured by a corporation or a trust, managed by a professional management company, and overseen by the board of directors. And finally, each fund hires an investment advisor to ensure security of the management within the portfolio's line of objectives. Moving on to the mutual fund's advantages and disadvantages, we can see that it comes with many advantages and a few minor disadvantages. So the first one is diversification for the advantages. The mutual fund provides diversification, spreading risk across many investments. They're managed by professional fund managers who have more experience and research tools that most individuals don't. They offer liquidity, meaning you can easily buy or sell your shares. There's plenty of flexibility and convenience with thousands of funds being available for different goals. They come with low transaction costs because the trades are made in bulk. Funds often include extra services such as automatic reinvestment or account tools. And finally, they help investors avoid bad brokers and high pressure sales tactics. However, mutual funds do come with a few disadvantages, one being cost and management fees that can eat into the returns. They may also trigger taxable distributions, meaning if you yourself don't sell your shares, you can owe taxes on profits. And the most important one are that many actively managed funds have lower than market performance. In fact, most fail to beat their benchmark indexes over time. So we can see in this photo to the right, it's a graph of failure of actively managed funds, and roughly 80% of stocks underperform the market S&P 500.
Let's start with the structure of a mutual fund. A mutual fund is basically an investment company that pulls money from many investors to build a diversified portfolio of securities. This structure gives individual investors access to professional management, diversification, and share returns, things that will be difficult to achieve on their own. Now, in legal term form, mutual funds are typically set up as either corporations or trust. The owners are the shareholders, and they actually own the fund and elect the board of directors to oversee it. Then you have the operator, which is the management company that runs the fund on a day-to-day basis, handling the trading, reporting, and compliance. And finally, you have the portfolio manager, and this is the investment advisor hired by the fund to make the actual investment decisions. Here I have a quick example of if we have 100 investors and each of them put $10,000, the fund starts with a total pool of $1 million. If that portfolio grows 1.2 million, then each investor's 1% stake is now worth $12,000. So everyone's shares grows in value proportionally. And just as a side note, according to the Investment Company Institute, about 35% of mutual fund owning households identify retirement as their primary reason for investment in a mutual fund, so they play a major role in long-term savings. So now moving on to the different types of investment companies. These companies come in several forms, each with distinct features and investment objectives. The most common one are open-ended mutual funds. These can issue an unlimited number of shares depending on investor demand. Shares are bought directly from the fund at the fund's net asset value, which we'll explain more detail later. Because of that, open-end funds don't trade on secondary markets like stocks do. Next, we have the closed-end funds. These issue a fixed number of shares only once during their initial offering. After that, those shares trade on stock exchanges just like regular stocks. Their price isn't determined by the net asset value directly, it's determined by supply and demand in the market. So they may trade at a premium or discount relative to their net asset value. For example, if a fund's NAV is $20, but its market price is 21, that's a 5% premium. If instead it trades at $19, that's a 5% discount. Then we have unit investment returns, and this consists of a fixed portfolio, usually bonds, and they aren't actively managed. These securities are held until maturity, and each unit represents proportional ownership in that portfolio. We also have the real estate investment trust, and these ones pull money to invest in real estate assets and must distribute at least 95% of their taxable income as dividends to investors. And finally, we have the exchange traded funds, and these are hybrids between mutual funds and stocks. They trade throughout the day on exchanges, and investors can buy them on margin or sell short, which gives them more trading flexibility than traditional mutual funds. And finally, um, let's take a look at how mutual funds are actually priced through the net asset value. The NAV represents the dollar value of a single share in a mutual fund. It is calculated by taking the total market value of all fund securities, subtracting any liabilities, and then dividing by the total number of shares outstanding. For example, if the total market value of securities is 850 million, liabilities are 50 million, and there are 40 million shares outstanding, the NAV would be 850 minus 50 divided by 40, which equals the $20 per share. So if you invest in that fund, you'll buy or redeem shares at that 20%, at that $20 price. However, it is important to highlight that closed-end funds are an exception here. Even though the NAV determines the intrinsic value of the fund, closed-end funds trade on the stock market, meaning their market price depends on investor supply and demand. And that's why they can trade at a premium when the market price is higher than the NAV or at a discount when it's lower. For instance, if the NAV is $20 but investors are willing to pay 21, that's a 5% premium, and if the price drops to $19, that's a 5% discount. So while open-end mutual funds always trade at their NAV, closed-end funds can deviate from it, creating opportunities but also risks for investors. And to wrap up, mutual funds and other investment companies give investors access to diversified, professionally managed portfolios. Understanding the structure, the types, and how NAV works, especially how closed-end funds can trade at a premium or discounts, is essential to understanding how these investment vehicles operate in real markets.
Alrighty, so now we will discuss the calculations of mutual funds costs and their returns, starting with the costs of mutual funds. The first distinction is between a load and no load funds. A load essentially just means that there is a sales commission, which is a fee that you pay either when you buy or when you sell the shares, depending on if it's Class A, B, or C. No load funds, on the other hand, don't charge that commission because you buy directly from the investment company and not through a broker. So I said before, there are three classes of load funds that we should go over. Class A shares have a front-end load, which means that you pay that fee right when you invest. So for instance, if you invest $10,000 in the American Funds Growth Fund of America, which is a Class A mutual fund, you pay a front-end load of 5.75%, meaning that when you purchase the fund, you are already in the hole by 5.75%. Only $9,425 of that $10,000 is actually invested. You lose $575 immediately. Class B shares charge a back-end load or a deferred sales charge when you sell your shares. It typically starts around 5% and drops each year until it disappears around after 5 to 10 years. So for example, if you buy the Putnam Small Cap Growth Fund Class B mutual fund, they charge a 5% back-end load, meaning that if you sell your shares in the first year, 5% is taken by the fund. If you sell the fund in the second year, you might pay around 4%. If you sell it in the third year, maybe around 3%, and so on. So the incentive here is to hold the mutual fund and sell after 5 years. Each Class B mutual fund charges slightly different fees, but the overall structure remains the same. And then Class C shares usually contain both a front and back end load, and they charge the highest annual fees overall. So it's pretty simple. For most investors, a no load fund makes the most sense. You avoid that commission entirely, and you keep more of your money within the mutual fund working for you. So now, once you've chosen a fund, you still have to look at the ongoing management and operating costs, which are shown in the formula called the expense ratio. The expense ratio compares a fund's total annual expenses to its total assets. Typical ratios range from 0.05% on the low end to about 2% on the high end. These expenses of mutual funds include anything from management salaries, trading costs, accounting costs, legal fees, basically everything that the mutual fund needs to operate efficiently. Inside the expense ratio, you'll often find the 12b-1 fee, which is a marketing fee for the mutual fund, which ranges from 0.25% to 1%. It's supposed to pay for a mutual fund's advertising and distribution costs, but in reality, this doesn't improve the fund's performance. It is just purely a marketing fee. It's considered a hidden ongoing load that reduces your return quietly. So here's a simple comparison. If you invest 10K for 20 years and both funds earn 10% before fees, Fund A has a low expense ratio of 0.5%, and that ends up reducing your net annual return from 10 to 9.5%, ending up with an ending value after 20 years of $61,500. If you choose to buy into Fund B, which has a higher expense ratio of 2.5%, which includes a 1% 12b-1 fee, your net annual return is reduced to 7.5% per year, and you end up after 20 years with $42,200. So that's just a $19,300 difference, or about 31% less wealth just from higher fees of 2%. So the lesson here is to always look at the total expense ratio and not just the management fee. Even a small difference of 1 to 2% can compound into massive wealth gaps over time. So this slide explains how we calculate returns for a mutual fund, meaning how we figure out what you've earned from your investment over time. The total return comes from three main sources: dividends the fund pays out, capital gains from selling investments, and changes in the fund's net asset value, or NAV, which is basically the price of each share, which we actually discussed how to calculate in a few slides before. So in this first example, if the fund started at $19.45 and ended at $23.59, again, NAV, paying 60 cents in dividends and 47 cents in capital gains, using the formula, your total return would be about 26.8%. That is your simple 1-year return if you took those cash payments and you didn't reinvest your dividends. But in reality, most investors reinvest their distributions, meaning that they use the dividends to buy more shares of the same fund. That changes everything because now you have more shares growing in value. In the second example, you start with 500 shares at, again, $19.45. Multiplied, that's $9,725 invested. By reinvesting the dividends of 60 cents, you end up with 585 shares by the end of the year. When the NAV goes up to $23.59, the total value of your investment is about $13,800. Using the reinvestment formula for returns, which essentially is just a percentage change formula, beginning end minus beginning divided by the beginning value, you get 41.9%, which is significantly higher than the earlier 26.8%. That's because those reinvested dividends were also compounding in value, basically meaning that they earn returns upon returns. So to wrap up, investors should aim for no load funds, low expense ratios, and low 12b-1 fees. And remember that reinvesting, distributions, and compounding is what really drives long-term growth.
Thank you, Tristan. Now we're going to move on and talk about different types of mutual funds. Starting off, we have money market funds, which invest in short-term securities like treasury bills and certificate of deposits for usually less than 30 days. They carry no loads, trade at a constant 1 net asset value, and have minimal expense ratios. Some tax-exempt money market funds and government security money market funds are two examples. Also, an example is Vanguard's VMFXX fund, which invests in short-term U.S. government securities and aims for capital preservation liquidity with roughly a 4.12% compound yield rate. All of these are linked, so if anyone wants to go back in the future and look at them, they're more than welcome to. Moving on, we have stock mutual funds, which offer long-term growth through equity types, including like aggressive growth, value, sector, index, and international. VIGAX, which is another Vanguard index fund, has a 19.7% year-to-date return, and that is typically because it is high risk, so you do have that high return. Now you have balanced funds, which are a mix of stocks and bonds for long-term growth, income, and stability. These typically hold common stock, bonds, sometimes preferred stock for individuals who need income with more moderate stability. And Fidelity's Balanced Fund, FBALX, is a prime example of that with a year-to-date return of around 11.88%. Next, moving on to asset allocation funds, which invest in stocks, bonds, and money market securities. These move money between stocks and bonds to outperform the market, and balanced funds practice market timing. An example of this is Vanguard's Life Strategy Growth Fund, which has roughly 80% stocks and 20% bonds with a yield of 18.28%. Now moving on to life cycle, target retirement, and bond funds. So life cycle and target retirement funds are mutual funds that try and tailor the holdings to the investor's characteristics, mostly going around age and risk. And these typically are managed based on when you plan to retire. So an example of that is Vanguard's Retirement 2065 fund, which slowly decreases exposure to stocks and increases exposure to bonds as the target retirement date approaches. And so far, that has about a 10.55% return since its inception in 2017. And then you have bond funds, which are mutual funds that primarily invest in bonds and fluctuate in value with market interest rates. And these are typically used with smaller amounts of money to stay liquid. An example being Vanguard's VBTLX, which is a fund that provides broad exposure to US investment bonds, and it has roughly 7.35% year-to-date return. And then you have three kind of different sections of how you would separate bond fund maturities. You have short term, which is 1 to 5 years, immediate term, which is 5 to 10 years, and long term, which is 10 to 30 years. Next, we have government, municipal, and corporate bond funds. So the U.S. government bond funds are backed by the U.S. government, and it's typically considered a very safe investment in that regard. You have Vanguard's U.S. Government Bond Index Fund, which tracks only U.S. government bonds, including treasuries and government agency bonds. Then you have municipal bond funds, which offer tax-exempt income, and it's really good for high-income investors. And an example being Fidelity's Municipal Income Fund. And then you also have corporate bond funds, which invest in company-issued debt, and they typically have higher yields, but that does come with more risk. And these are used for diversification, income, and reduced portfolio volatility. And both Fidelity and Vanguard have fund options for this. Now we're moving on to ETFs, or exchange traded funds. These are basically a hybrid between a mutual fund and an individually traded stock or bond that trades on an exchange, like securities typically do. And these can be bought or sold intraday, compared to mutual funds that are at end of day. How ETFs work is they're traded throughout the day like your stock on a typical exchange would, and they offer diversification, flexibility, transparency. Some advantages are they charge lower annual expenses, but they still pay trading commissions. They're more tax efficient than mutual funds, and they allow investors to stake out investment positions in a sector, industry, or countries during market hours. Some popular ETFs are SPY, which is the S&P wrapper ETF. You have JTech, which is the JP Morgan Big Tech Leaders, and you have Invesco QQQ. Now, kind of going on to kind of show the difference between them. With trading style, an ETF is traded again like a stock on an exchange throughout the day, whereas the mutual fund is once daily at the end of day net asset value. Fees, ETFs typically have lower expense ratios due to usually more passive management, whereas mutual funds are generally higher, especially if they have active management. A minimum investment, you can buy as little as one share of an ETF. However, mutual funds do require typically $1,000 to $3,000 as a minimum investment. And most of the Vanguard funds that were shown earlier do have that minimum investment. Tax efficiency, ETFs are typically more tax efficient due to in-kind redemption, and the mutual funds may trigger capital gains distributions more often just because of that like minimum investment. And then you have dividends, which are paid out or reinvested through the broker, and mutual funds are typically reinvested within the fund. So mutual funds are typically best for investors who are preferring hands-off long-term investing, whereas ETFs are investors seeking more low-cost flexibility and intraday trading that they can trade throughout the day.
Hi everyone, I'll start by going over the key services offered by mutual funds and how they help investors build wealth over time. Mutual funds provide several built-in tools that make investing simple and disciplined. First, automatic investment plans allow investors to set up recurring contributions. For example, $200 invested monthly in an S&P 500 fund. This strategy makes investing effortless and consistent while taking advantage of dollar cost averaging. Next, most funds offer automatic reinvestment of dividends and capital gains, meaning earnings are used to buy more shares automatically. This compounds returns over time and helps investors stay fully invested. Mutual funds also simplify retirement planning by making it easy to open IRAs or 401k rollovers and invest tax deferred. Another key benefit is tax record keeping, since fund companies track distributions, cost basis, and issue year-end tax forms for investors. Finally, there are additional services like online transfers, check writing privileges, and easy switching between funds, which add convenience for everyday investors. Overall, mutual funds are designed to automate and simplify the investment process while promoting long-term financial discipline. Next, let's look at how to actually buy a mutual fund and what that process looks like. The first step is determining your goals and risk tolerance, for example, saving for retirement or education. Then match your objectives with the right fund type, such as a growth, balanced, or income fund. Third, evaluate performance and costs, paying close attention to the expense ratio and long-term track record of the fund. Finally, you purchase the fund directly from the company or through a platform like Fidelity or Vanguard. Here's an example to make it more concrete. Let's say your goal is retirement in 30 years. You might choose the Fidelity Freedom 2055 fund, which automatically adjusts its portfolio as you approach retirement. It's diversified across US and international equities with a small bond allocation and has a small expense ratio of 0.68% with no minimum investment requirement. A common strategy would be to invest $200 automatically each month and reinvest dividends. This is a simple and consistent plan for long-term growth. To wrap up, here are a few key takeaways. Mutual funds are diversified, professionally managed portfolios that pool money from many investors to buy a mix of stocks, bonds, or other securities. They provide instant diversification and professional management. However, it's important to remember that most mutual funds underperform the broader market after fees and taxes. That's why expenses and taxes really matter. Lower expense ratios and lower turnover generally lead to higher net returns for investors over time. For most investors, passive index funds tend to outperform because they track the market, keep fees low, and avoid unnecessary trading. In fact, most active managers fail to consistently beat their benchmarks. Lastly, it's important to match the fund to your personal objectives, whether it's a growth fund for long-term wealth building, an income fund for steady returns, or a balanced fund for moderate risk. Always align your choices with your time horizon and risk tolerance. Overall, mutual funds remain one of the most accessible, disciplined, and effective ways for everyday investors to build long-term wealth.